Please subscribe the channel and press bell icon for notifications.
Today, Apple stock rises after a report that the iPhone maker will start production on an electric car in the next 4 years. Plus, shares of Peloton hit an all-time high after news of a big acquisition. And finally, forget holiday shopping online. The packages won't arrive in time for Christmas. We explore what last-minute shopping in brick-and-mortar stores looks like during a pandemic. I'm Mackenzie Sigalos, and this is CNBC After Hours. Another mixed day for stocks as the Dow and S&P finished lower, while the Nasdaq closed at a record high. The Dow's best performer today? Apple. The stock popped close to 3% after a report last night that the tech company, famous for smartphones and computers, will begin production of an electric vehicle by 2024. Now, Tesla, the stock market's current favorite electric car maker, took a hit today on the news. Of course, despite today's loss, those shares are still up an insane 665% this year. Elon Musk weighed in on Twitter, calling the reports, quote, strange, and claiming that he tried to sell the whole company to Apple, but Tim Cook wouldn't even meet with him. For what it's worth, Apple declined to comment on the tweet. Elon Musk aside, the car business is hard and it's expensive. CNBC's Josh Lipton explains what Apple could be facing.
Is Tim Cook ready to take the wheel of the auto market? New reports now suggest that Apple could introduce a self-driving car by 2024 with its own breakthrough battery technology that would lower cost and increase the vehicle's range. Apple declined comment on that report, but it's easy to understand why Cook could be interested in developing a car. The auto industry represents a big opportunity, a $2 trillion market. And Apple does have certain advantages: a strong balance sheet, deep pockets, a world-class design team, and a proven ability to seamlessly integrate hardware, software, and services. Analysts are also quick to point out that Apple has now brought in-house many of the technologies that could help in developing such a car: processors, battery, camera, sensors, and display. Perhaps some think Apple could upend and redefine the auto market just as it did with smartphones and wearables. On the other hand, there would be real risks for Cook as well. Ultimately, for all the excitement, the auto industry is a low-margin, capital-intensive business. Is that really where Cook wants to place such a big bet right now? That's why some analysts covering Apple believe that when it's all said and done, Cook is more likely to focus his money, time, and effort more narrowly on software. For example, an autonomous driving system that Apple could then sell or license to traditional car makers. If you're investing in Tesla, you obviously might see this as a potential risk. On the other hand, remember when we talk about EVs, electric vehicles, they only represent, analysts say right now, about 3% of total cars sold, but there's a lot of room for growth. Analysts think that over the next 5 years, they'll probably represent something like 30%. I think it's why some people believe on the street the real threat, if Apple does actually get into this market, it's not so much to Tesla, but maybe they think to more traditional car makers. Apple, of course, is a lot bigger at this point than those traditional automakers, whether it's GM or Ford. You can think of a lot of reasons why Apple could be interested in building its own car, but there's some real issues they'd have to address as well. Just the Herculean task of building out a supply chain, ramping up your production, and also remember, for all the headlines, the car industry is a low-margin business. Now, having said that, the reports indicate that they have really developed some breakthrough battery technology that would lower costs. So that's another wrinkle that perhaps, if these reports are accurate, Tim Cook and his CFO, Luca Maestri, would be considering before launching their own Apple-branded vehicle.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves.
A very divided Washington. This is close to a Christmas miracle you're going to get. We really, I think, brought both sides together, Democrats and Republicans, obviously, in the problem solvers, but across the Congress and in the Senate, where we worked with Republicans and Democrats there.
Facebook and Google can say all day long that they did nothing wrong, but there's going to have to be a better explanation than a statement saying the claims are baseless if they actually want us to believe them.
But look, Miami's been flying for a long time. I've been buying real estate in Miami for over 20 years, and it's been a great flight. Since COVID started, it's a rocket ship. And one of the things that's really interesting that's happening here is talent's coming in.
With every delivery we take, our ownership costs are going to go down, our maintenance costs are going to go down, our fuel costs are going to go down, and our revenue should go up.
All right,
Please subscribe the channel and press bell icon for notifications.
it's crunch time for holiday shoppers. And for anyone who hasn't checked everything off their list, it's definitely time to forget online shopping. Most shipping deadlines have passed for major carriers, and even if you could find a delivery date before Christmas, you likely shouldn't risk it. According to the U.S. Postal Service, holiday shipping volume is up 14% compared to 2019. That surge in new packages traveling cross-country is causing a wave of delays. Many packages could arrive after the 25th. So in these final days before Christmas, any gifts will have to come from brick and mortar retailers. But with so many changes to consumer behavior this year, what does last-minute shopping look like in a pandemic? And are these changes here to stay? CNBC.com retail reporter Melissa Repko can break it down for us.
The bad news for shoppers this year is that the shipping deadline ends earlier than ever. But the good news is there are a lot of options for shoppers who are looking for gifts last minute and still need to go to the store or even want to shop online. A lot of stores have added curbside pickup during the pandemic. Retailers are investing heavily in curbside pickup and anticipating that that will be a new habit that sticks even beyond the pandemic. A lot of people of all ages and all backgrounds and all levels of tech savviness have downloaded apps from retailers to enable curbside pickup. And a lot of the retailers like Walmart and Target and even mall retailers have restructured the way that they use their employees. So instead of just helping customers on the sales floor, instead they're also picking and packing orders that are then ready for someone to pick up in their car or to even be delivered ultimately to their door. The other dynamic is because of the shipping crunch, people may not have received packages in time. So the gifts they'd ordered may not be to them. And so they may be going out and getting double the gifts because they're worried they won't get that gift in time. And that will eventually potentially lead to more returns and the complexness that retailers will have to face in the new year. In the final days of holiday shopping, a lot of the last minute shoppers tend to be less price sensitive. They're eager to throw gifts in their cart and they're perhaps a little bit crunched on time, a little bit nervous about getting everyone gifts. And so they tend to be a little bit more impulsive. And impulsive spending is really a big part of the overall holiday shopping season. It drives about 25% of spending overall, according to a market research group, the NPD group. This year, that impulsive spending is expected to drop to 18 to 20%, which adds up to a potential loss of billions of dollars for retailers. The reason why that's happening is because people aren't seeing the typical store displays. They aren't hearing Christmas music. They aren't experiencing the same environment in the stores because so many of them are buying gifts online instead. And that is forcing retailers to think differently about how they introduce shoppers to new items and how they push them to add extras to their cart. But the holiday season is really when people are shopping and have a certain level of urgency and they expect retailers to deliver. And these are new services for a lot of retailers. So we'll have to see how the retailers do. So the winners and losers will become really clear. Like some retailers are adding these services, but they're gonna suck and people are gonna have a negative experience and say, I'm not gonna do that again.
Okay, time for today's numbers round. We'll start with 420 million. Peloton stock hit a record high today on the heels of the at-home fitness company's announcement that it will buy exercise equipment manufacturer Precor for $420 million. Now, demand for Peloton's stationary bike and treadmill offerings surged during the COVID-19 pandemic as people shut out of gyms looked to work out at home. The new orders put a strain on Peloton's supply chain, resulting in shipping delays and reports of poor customer service. The thought is that the Precor deal will help accelerate equipment production and shorten wait times. The deal is expected to close early next year. Next, $1.3 billion. The SEC has charged crypto firm Ripple, along with two of the company's top executives, with conducting a $1.3 billion unregistered securities offering. Now, Ripple is best known for its cryptocurrency XRP, which has spiked about 150% in value this year. The company claims that XRP is a currency and therefore isn't subject to the same laws as securities. The SEC, however, is alleging in its suit that XRP is in fact a security and that Ripple violated the laws by failing to register it with the agency before selling to investors. So why does all of this matter? Well, XRP is one of the most valuable cryptocurrencies with a market cap around $20 billion. And crypto has been a hot trade in 2020. In addition to XRP's gains, Bitcoin, the most popular cryptocurrency, has more than tripled. Also, major crypto exchange Coinbase just filed for an IPO. With more money flowing into the space, the scrutiny is following. And finally, 1,000. Goldman Sachs, the storied investment bank with a history of only catering to the rich, is now testing a new automated investment service that requires just a $1,000 minimum investment, according to an internal email viewed exclusively by CNBC. Now, for decades, Goldman pursued corporate, institutional, and ultra-wealthy clients with at least $25 million to invest. This new service, called Marcus Invest, is the latest move in the bank's effort to open new lines of revenue from Main Street investors, aka normal people, not the 1%. Banking reporter Hugh Son broke the story. Read his whole piece on Goldman and Marcus by going to CNBC.com and downloading the CNBC app. That's it for After Hours. We'll be back here in our home office tomorrow with one final show before the Christmas holiday. So be sure to catch us then.
Please subscribe the channel and press bell icon for notification.